Welcome to the concluding chapter of this masterclass on integrating risk and finance in association with SAP. My name is Brian Caplen, editor of The Banker, and to discuss this topic I'm joined by Mike Russo, who is SAP's Senior Financial Services Solutions Principal, and Falk Rieker, who is Global Head of Banking. And in this final chapter, we're looking at how to improve bank performance with integrated financial and risk reporting and analytics. So Mike, if I can come to you first, banks should be focused on profits. How can we improve their profits with these techniques?
Yeah, well, I think again, in this current environment where costs are being driven by regulation, right? So we think about the cost of capital, we think about the cost of liquidity. It's really, I think the next generation of high performance is going to have a good awareness, through their reporting and analytics systems of what the impacts are, to activities that they undertake, before they actually get done, right? So I think that's very, very important going forward. In order to impact performance management, you really need to understand, what the underlying costs are, and this sort of morphs into, how do I allocate my capital, right? I think banks in general want to be able to allocate capital towards those activities that are producing the highest risk-adjusted returns. So I think analytics and being able to do analytics very dynamically is a big part of what needs to happen in order for banks to be in that position.
Do you think there's a little bit of a danger with the extent to which the regulator is pushing the banks to do the stress testing to such a degree of granularity that the banks start to become a little bit similar in their business models and they're starting to compete too much with each other?
Well, I think again, I think everybody, every bank is somewhat different. When you look at stress testing, everybody's got a different composition on their balance sheet. So I wouldn't necessarily think that, being able, having to do these stress tests, puts them in a competitive situation. But I think again, the ability to be able to dynamically do scenario analysis and stress testing, puts the banks, in a very good position, to predict. What the future will look like, and so I think and to be able to act on that belief, very proactively. So I think, again, the technology, plays a big role here. This ability to be able to, look into the future, understand, what the drivers of performance are, and be able to react proactively, I think is, one of the things that will separate, the next generation of high performers from everybody else.
Okay, Mike. Mike has talked about the sort of upside in terms of profits with this process. Mm-hmm. But are there other things that the banks can gain through going through this very, very long process?
Yeah, first of all, I would like to state, better insight means better decisions and better business at the end of the day. So I think that goes along with managing data smarter, having more insight, more transparency on what's going on, will benefit the business in itself. Because on the one side, you're focusing on business that is attractive. On the other side, you avoid business that is not attractive. Concrete example. Met with the customers. They have 300 million customer records each month. And they have it down to each customer, each product. So they exactly know which customer uses which product in which channel. So what can you do with that data? You can, for example, come up with pretty smart marketing campaigns that take a look at some behavior, which channels are used by which customers, which products are preferred by which customer groups, and then have much more intelligent marketing campaigns than we see of some of the banks, when they send their credit card proposals for the 5th time.
Well, that's what I was going to say, yeah. The banks have a reputation for doing it on this sort of broad approach where there's just scattergun everywhere, don't they? And you think that the banks with this tool could actually segment the customers much more accurately?
They have to. So let's just take a look who they compete with in the future. It will not only be banks. It will be telcos, it will be retailers, it will be a lot of non-banks. And these non-banks are pretty good when it comes to customer experience. And they will leverage their insight about the customer, how they treat the customer. They will come up with tailor-made offerings for these customer groups, with tailor-made pricing. And if the banks don't react to that, they will lose a good portion of their existing market.
Okay. So Mike, Falk mentioned the idea of non-banks coming into the business there. I mean, what do you expect to happen? At the moment, the banks say that it's unfair because the non-banks are not regulated in the same way they are. I mean, do you expect that to continue, or do you think that eventually everybody will be drawn into the same net if they're operating in the financial services area?
Yeah, it's hard for me to imagine that the regulators would sort of lay back for too long. As I see portfolios starting to build outside the banking sector, I believe that they will cast the umbrella much wider. But the other thing that I thought was interesting, just a quick follow-on to what Falk was saying. Part of what I see with analytics very often is that when banks see various metrics reported, right? Sometimes they're happy and they're sad, but they're not necessarily any smarter, right? I think the key is to really understand what drives financial performance. So if you look at a metric like return on equity, and you see it's going down from one quarter to the next, directionally, it's not moving in the direction. But what you really need to do is understand, what levers you need to pull in order to be able to impact that performance. And sometimes, a high-level metric like return on equity, if you look beneath it, it's composed of a number of different underlying or sub-metrics, which are really the ones that you control. So I think, again, when it comes to analytics and reporting, I think the next generation of reporting is going to start to be a lot more focused on root cause analysis and basically understanding, what levers need to be pulled in order to be able to impact financial performance.
Okay, gentlemen. Well, we look forward to the banks taking away this advice and making better profits in the future. Thank you very much.
Thank you.
Thanks.